And the big developing story, which will actually unfold India time tonight, is the US Federal Reserve's meeting, which is going to begin today in the US, and markets around the globe are expecting a 25 basis points cut. The Fed Reserve is set to make its final interest rate decision of 2024 this Wednesday, which is tomorrow US time, with expectations for a third consecutive rate cut. Now, this follows a major move in September when the central bank in the US reduced rates for the first time in 4 years, providing a much needed relief to borrowers amid ongoing inflation concerns. Remember, US inflation came at a 2.7% print. Joining us on the show now is Andrew Holland. Andrew Holland, good morning. Thank you very much for taking out time this morning. Help us understand the US Fed, the central bank's FOMC meeting. What are you expecting of it, and how should an Indian citizen really be concerned about what the US Fed does?
Well, I mean, in terms of what the Fed will do, I think everyone's expecting that 25 basis points rate cut. Maybe there'll be a little bit more of a hawkish statement around it because, the economy is still strong, inflation remains elevated. And I think, going into the new year, obviously you have President-elect Trump, taking over as the U.S. administration. So, that will bring its own challenges, I think, for the Federal Reserve going forward. But for India, obviously, it gives us the opportunity in February for the RBI to cut interest rates here, which obviously would help people in terms of lower loan repayments and EMIs going forward. So that would be the beneficiary of another rate cut by the Federal Reserve this week.
Okay, Andrew, do you still believe that India's rate decisions are still coupled with the US? Because last two cycles in the US, which started with rate cut, is not something that India followed. So is it fair to assume that India is still going to follow its own independent inflation mark trajectory on rate decisions and not really be concerned with what happens in the US?
See, I think we can't kind of ignore what's happening around the world in terms of interest rate cuts. Because obviously it has an impact on the currency at some point as well. You probably don't want your currency strengthening, going forward if everyone is reducing rates. So that's one point. I think for India, obviously, food inflation remains the mainstay of the higher inflation. So until that comes down, that it's going to be tough for the RBI to take, kind of aggressive action. But that said, the economy is slowing very quickly, and I think the new RBI governor, has the opportunity to kind of think pro-growth and pro-business. So therefore, maybe ignoring some of the inflation upticks at the moment, and saying that food inflation will come under control over time, and therefore we need to help boost the economy and kickstart animal spirits with corporates in terms of investments as well.
Right, animal spirits, that is something that, of course, we have been talking about here, and we need the capex cycle to kickstart. But I want to shift focus, Andrew, now to the inflation data which came out yesterday. Following the trend of the CPI inflation, India's wholesale price index-based inflation, or WPI, has also eased now to 1.89%, well below the 2% threshold in the month of November. And this largely by a rise in prices of food articles, food products, textiles, machinery, and some manufacturing goods. Now, WPI inflation was lower at 0.39% in November last year, 2023, while if you look at it month on month, it stood at 2.36% in the month of October. Meanwhile, the month on month change in the WPI for November came in at a negative of 0.06% compared to October. So what do you make of the inflation data at this moment? And therefore, is it still too early, Andrew, to assume that there is a trend line of inflation declining? Because inflation has been up and down, a bit volatile for the last few months.
I think you just highlighted that the real key here is the volatility in food prices, which is obviously not given comfort levels to the RBI up until now. I think if this trend continues of maybe benign inflation in terms of food inflation, then that opportunity, as I said, in February for the new RBI governor to cut rates, I think is very much in play. So I would think that we could go for 25 basis points in in February. Depending on what happens in the US, possibly you could go a little bit more as well. But I think the good news is that when you come to that meeting in February, is that you'll have some of the indications of the policies of President-elect Trump as well, to bear in mind of what you need to do to kind of keep our economy, kind of growing at. I mean, the RBI says 6.8% for this year. I think it's going to be nearer that 6%. So, there is a big slowdown. So there has to be some action taken, and I think interest rates will be one of them.
All right, Andrew, let's move now to the private sector. You had mentioned animal spirits and the hopeful revival in the capex cycle, but India's private sector output has grown at the fastest pace in 4 months, according to a survey, helping the economy end 2024, hopefully on a positive note. And this largely is underpinned by a more robust demand in services and manufacturing. And the job growth has also, according to data, been fairly robust. Now, according to HSBC's December flash, the India Composite PMI, or Purchasing Managers Index, which is compiled by S&P Global, has risen to 60.7 this month. Now, this is in fact matching August reading after it had dipped in the month of October or November to 58.6, while Asia's third largest economy grew a softer 5.4% in the last quarter. Easing inflation and private sector resilience are expected to further boost demand and improve the outlook for next year. Is that true? Are you expecting a better outlook for next year, given that manufacturing has continued to stay above 50, which means there has been growth, and now touching the 60 plus levels?
There's a couple of factors. I think, first of all, we'll have to start to see the government expenditure start to pick up, because obviously that will have a multiplier effect. Now, we know that the first half of the year has been pretty benign, so everyone's been hoping for the pickup in the second half of the year, but we're still awaiting that. So some of that multiplier effect, won't be felt till late 2025, as soon as they do that. And of course, once that happens, then of course the private sector starts to pick up as well. So I think with that boost from the government, an interest rate cut, and possibility of more interest rate cuts from the RBI going forward in 2025, that I think will push corporates to pick up expenditure across many different industries. And I think there's the manufacturing industry, the kind of electronic manufacturing industry, I think that's where we're going to start to see a lot more investments, not just by local Indian companies, but by foreign companies as well. So FDI should start to pick up in this area. And I think one of the things I'm picking up from the government is that, tourism in India is something that they want to focus on. And again, that could be, very good news, not just in terms of employment, but if you think about pre-COVID, foreign tourists is still, I think, below pre-COVID, kind of time. So there's an opportunity there, to bring in, obviously, money from people spending in India, but also help grow jobs in the future. So I think that if they concentrate on those two sectors, it's good for jobs, it's good for the economy, and it would be good for, for corporate India as well.
You, Andrew, and I think what you're saying is absolutely logical at this point, because we are at record outbound travel, but pre-COVID levels and below for inbound travel coming into India. So we definitely need the US dollar, the greenback, to flow into India. But unfortunately, that is not something which is being reflected in India's export story. In fact, going back to data, India's exports have contracted by almost 5%, 4.85% or so year on year in the month of November, totaling about $32.11 billion, while the trade deficit has now widened to a record high of $37.84 billion. And guess what's driving this surge in imports? Well, none other than the yellow metal gold. Now, this decline has actually followed a period of double-digit growth in the month of October. Andrew, help me understand, what is the fascination with India importing gold at a time when gold in any case is touching its own record highs?
Yeah, well, I mean, we all know trying to get hotel rooms or even trying to book any events at the moment is a no-go because of all the weddings which are going on, and obviously,
the traffic is another story. It's not just the hotel rooms. Go ahead, Andrew.
Exactly. So that gold demand is there. I think also, people are looking at gold as an investment. It's done very well over the past year, in terms of against the stock markets and other kind of alternate assets. So, in a kind of a year, maybe in 2025, with some uncertainty as well, globally, then you would see that demand for gold remains strong. I think for the export side of for India, Europe's in a bit of a mess at the moment, both politically and in terms of the economic outlook, and the UK included in that. So there's a bit of a sharp slowdown there, and that's why you see more aggressive rate cuts in Europe. And of course, for the US, it's a growing area for India, but it's not really overtaking China at this point. So I think there's a long way to go on the export side, but I think the story is more of electronic manufacturing, textiles. I think there's an opportunity there, and then trying to get some inbound foreign direct investment as well as tourism.
Right. So I don't know, maybe it's a little early right now, but do you think, some relaxation in FDI norms and making taxation a little more lucrative is something that Finance Minister Nirmala Sitharaman will perhaps consider in her first February budget speech?
Yeah, it's always a tough one. I'm sure we're going to play up the budget and all the expectations there. There's one trend which I think we kind of ignore. We always think about the positive side of tax, right? But obviously we did see an increase in capital gains tax, and I'm just wondering if that's going to be a continuing element of increasing taxation revenues for the government. So on one side, I can see what you're saying. I don't think we'll see so much in this budget in terms of tax reforms, but the stock market might be one area which they continue to look at.
All right. Well, let's stay on the tax story for just a little longer, Andrew. The GST Council, which will again be chaired by Finance Minister Nirmala Sitharaman, is, according to media reports, considering a proposal to reduce the GST on food delivery charges by e-commerce operators, the likes of Swiggy and Zomato, from the current 18% to about 5% or so. Now, this effect is likely to come into place from the 1st of Jan. But again, this is just media reports right now. We don't have independent confirmation. But Andrew, how do you look at, let's say, stocks like Zomato and Swiggy? And are they going to be in a position to, let's say, claim tax credits on especially the overdue tax charges that have been slapped on a company like Zomato in excess of 800 crore rupees? How do you view India's overall e-commerce and food delivery app story, especially on listed companies like Zomato and Swiggy?
Yeah, well, if the proposals you just said do come through, then obviously it's a huge benefit to these companies, and will only accelerate the growth, I think, for these companies at probably the detriment of the kind of traditional FMCG companies. And I think that's what the market's been telling us, hasn't it, over the past 6 to 9 months. It's been the new technology delivery type companies which have been doing very, very well. In terms of, if you even think about a year and a half ago, we used to kind of say, let them get to profitability or cash flow positive. And all of that is kind of, kind of happening now. But when you look at the FMCG companies, it's marred by, low revenue, margins under pressure. So there is a shift, I think, to these companies. But if there's a reduction in GST tax, then that would be a big positive for the whole sector.
Of course, a big positive for Gurgaon's richest man, Dipinder Goyal, at least. But let's move on to India's richest billionaires, Mukesh Ambani and Gautam Adani, who have both dropped out of the Bloomberg's $100 billion club for the year amidst ongoing business challenges. Now, despite this, India's top billionaires saw overall growth in their net worth in 2024. Ambani, whose wealth stood at $120.8 billion in July this year, when his son Anant Ambani got married, has experienced a decline due to underperformance in his conglomerate's energy and retail sectors. Now, as of December 13th, Ambani's fortune is now valued below $100 billion at about $96.7 billion, according to the Bloomberg Billionaire Index. Now, for Adani, the troubles are more deep in nature. His conglomerate is facing threat from the US Department of Justice probe that could freeze any momentum as uncertainty extends. Now, Adani's net worth has fallen from $122.3 billion in June to $82.1 billion, well below the $100 billion as per the Bloomberg index. Now, I want to come to you, with this news, Andrew. There are obviously, issues that the US has found in the bribery case against Adani Enterprises. While I understand net worth is something that is completely dependent on the stock performance, but this ongoing US Department of Justice probe on Adani Enterprises, how do you view the Adani Enterprises stock story for investors? I'm not talking about traders who may enter, exit short positions today, tomorrow, but for long-term investors, how do you view the Adani story?
See, I can't really comment on individual companies in that respect, but generally, when these things happen, and it's happened across many different companies in the past as well, whether it's a SEBI inquiry or it's a tax inquiry, let the news come out first. Let's see exactly what's going to happen, rather than try and speculate on whether it's right, wrong, or whatever. So I think at this stage for investors, it's just wait for the news to come through,
Right.
Rather than take a view either side, because I don't think I'm in the know to even comment on some of this. It's all more legal, and it's got nothing to do with the fundamentals of the company.